Every single month, you hand over thousands of dollars to your bank for your mortgage. But here's what nobody tells you. Your bank probably doesn't keep a single cent of it. In fact, within 30 days of you signing those papers, your loan has likely already been sold to someone you've never heard of, bundled with thousands of other mortgages, sliced into pieces, and sold to investors halfway around the world. Your mortgage payment? It's not sitting in a vault. It's traveling through one of the most complex financial pipelines on the planet. And understanding it could save you from some very expensive mistakes. Stay with me. This gets wild. Let's start at the very beginning, the day you get your mortgage. You walk into a bank, a credit union, or maybe use an online lender. They review your credit, verify your income, and eventually hand you a loan. This process is called origination. The lender is called the originator. Now here's where most people stop thinking about it. They assume the bank holds on to that loan for 30 years, collecting your payments like clockwork. But that's almost never what happens. Banks are not in the business of sitting on loans. They're in the business of making loans. And to keep making new loans, they need capital, cash. So almost immediately after your loan closes, they sell it. To whom? That's where this gets interesting. Enter what's called the secondary mortgage market, and two names you need to know, Fannie Mae and Freddie Mac. These are government-sponsored enterprises, essentially government-backed companies whose entire job is to buy mortgages from lenders. Your bank sells your loan to Fannie or Freddie, gets a big chunk of cash back, and immediately turns around to make more loans. The cycle continues. But Fannie and Freddie don't just sit on your mortgage either. They take thousands of mortgages, yours, your neighbors, mortgages from across the country, and they bundle them together into what's called a mortgage-backed security, or an MBS. Think of it like a smoothie. Your mortgage goes into a blender with thousands of others. The blended product gets divided into portions called tranches, and those portions get sold to investors, pension funds, insurance companies, sovereign wealth funds, hedge funds. So when you make your mortgage payment this month, you might actually be paying a teacher's pension fund in Ohio or a government investment fund in Norway. Genuinely remarkable, right? Now here's the part that trips people up the most, and it's super practical, so pay attention. Even after your loan is sold, someone still has to collect your monthly payments, manage your escrow account, send you statements, and handle things if you fall behind. That entity is called the loan servicer. Your servicer might be your original bank, or it might be a completely separate company you've never heard of. And here's the kicker. Your servicer can change multiple times over the life of your loan. You might get a letter one day that says, your loan is being transferred to XYZ Mortgage Servicing effective next month. That's totally legal. That's totally normal. And that payment you send to your new servicer, they keep a small fee, usually around 0.25% annually, and forward the rest through the pipeline to whoever actually owns your loan. The servicer is essentially the face of your mortgage, but they're often just a middleman. Okay, so why should you actually care about any of this? 3 big reasons. Reason 1, your servicer changes, your rights don't. When your loan gets transferred, the terms of your mortgage cannot legally change. Same interest rate, same balance, same rules. If anyone tells you otherwise, that's a red flag. Reason 2, always know who your servicer is, because if you send a payment to the wrong company after a transfer, you could be marked delinquent, even if it wasn't your fault. Federal law gives you a 60-day grace period after a transfer, but don't rely on it. Update your records the moment you get that notice. Reason 3, this system was almost catastrophic and could be again. In 2008, this exact pipeline, mortgage-backed securities, tranches, global investors, collapsed spectacularly. Banks were making terrible loans because they knew they'd sell them off immediately and never bear the risk. The result was the worst financial crisis since the Great Depression. Reforms have been made since then, but the basic structure still very much in place. Here's the thing about your mortgage that's actually kind of beautiful in a strange way. When you bought your home, you probably thought you were just making a deal with your bank, but you are actually plugging into a global financial system that connects homeowners to investors, governments to pension funds, and Main Street to Wall Street. Your $1,800 monthly payment doesn't stay in one place. It fragments, it travels. A little bit pays your servicer's fee, the interest flows to bondholders, the principal chips away at the underlying security, and the whole machine keeps turning, financing new homes, new loans, new buyers. You are not just a homeowner. You are, whether you knew it or not, a tiny but essential node in one of the largest financial markets on the earth. So next time you make that mortgage payment, you'll know exactly where it's going and why it matters. If this opened your eyes, hit the like button. It genuinely helps this channel reach people who need to hear this. And if you want to understand more about how the financial system actually works, not how they teach it in textbooks, but how it really works, subscribe, because that's exactly what we do here. Next video, why your credit score is a lie and what actually matters to lenders. See you there.